Is your pension safe, or is prescribed assets still a risk that is on the table? Joining me to discuss this contentious topic is Magnus Heystek, who is an advisor with Brenthurst Wealth, an investment advisory company. Magnus, could you give us some background context to this prescribed assets discussion and how it is that we got to this point?
Well, there's always been the danger of prescribed assets, which means that government will prescribe to asset managers where they can invest their money. And in the past in South Africa, we've had prescribed assets, and that had a drastic impact on the eventual returns of individual members. That's been done away with, and for the last 25 years or so, it's not been a factor. But now that big stick is being hoisted again, and it's been debated for the last couple of years, following on the ANC's pronouncements that that's back on the table, because the private sector is not investing in government-appointed infrastructure funds or experiments or whatever you want to call it. So the debate has quietened down a little bit, but it doesn't mean that the danger has gone away. I think it's moved behind the scenes. Government and the pension fund industry representatives are having discussions about this issue. And some of the pronouncements that have come out said, yes, we are looking at infrastructure projects if they are bankable. Now, I'm not sure how they're going to know if they're bankable until they have been developed and implemented. So that's the danger. A lot of these things have not been bankable, like sunrolls, e-tolls, etc., and water schemes and electricity. None of them have given a return, or very little of them have given returns equivalent to other on the market. So the danger has not gone away. The debate has just changed focus. And in addition, the Regulation 28 has already had a massive impact on the returns of pension fund members. Most of them do not even know it, but on average, the pension funds in the last 5 years have shown no real growth after inflation in South Africa, which means you've lost 5 years of growth that you could have had was there a bit more freedom. So the debate has not gone away, and the danger has not gone away. And I suspect there are some decisions being made behind the scenes on behalf of pension fund members that they're not aware of, and they should be made aware of them.
So Magnus, one of the discussion points is around Regulation 28 of the Pension Funds Act. Could you explain how the asset allocation proportions work in terms of Regulation 28 and how that may have constrained growth in pension funds over the recent years?
Very briefly, many years ago, the pension funds industry and Treasury sat around the table and they devised guidelines as to where pension funds may or may not invest money in terms of exposure to certain asset classes, whether they are stock market investments, bond market investments, property, onshore, offshore. And a big factor the last 7, even to 10 years is that you can only have 30% offshore exposure within any portfolio, and that's at fund level. So only 30%, the balance of your equities must be in South Africa, and you're invested predominantly in South Africa. The bad news was that the bad news still is that the returns on the South African market has been exceptionally poor. The currency has been very weak over this period of time. So there's been very little growth, and the growth that you had has come from the offshore exposure. And that has not been enough to counteract the very poor performance of the local market, which has dragged down the returns. So the long-term returns on pension funds on average have come down from inflation plus 5, plus 6, have come down to inflation minus 1 or 2. And then that's where the stumbling block is. Many members of pension funds or even individual members of retirement funds would like to increase their offshore exposure for whatever reasons. But Treasury, as in conjunction with SARB, the SA Reserve Bank, have said 30% is the maximum. And that simply has not been enough for most members of pension funds.
So Magnus, in your view, do you think that there will be moves made to amend Regulation 28 in the future?
I think there's pressure on changing the formula in the sense that more money will be allowed to be invested in local infrastructure funds. Currently, the allotted percentage is quite low, and I think they're going to push that up quite dramatically. There might be a quid pro quo that you can at the same time push more money into offshore equities from maybe 30 to 40% to placate the industry and the pension fund members. So I wouldn't be surprised if that happens quite soon, but it's definitely going to be cajoling the members to invest in infrastructure funds, or the big stick will still come out one day.
So Magnus, do you feel that professional bodies and organized business associations are doing enough to counteract this prescribed assets risk?
It's very hard to judge, and I might be unfair saying what I'm saying, but it's very much a one-way street. There's very little interaction between the assessor and the general public, and in most cases tends to be very oblique and brief press releases. And a lot of people have commentated that there's this vacuum in terms of what's going on, what are the issues on the table, and that's simply not enough. So and individual members have actually got very, very little insight as to how the industry works. It's almost like a cartel. You're sitting, all the big pension fund players sitting around a table and talking to government and treasury and SARS, but there's very little individual interaction, contribution, or suggestion. So there's a bit of a problem. It's a top-down, us and them, and really take it or leave it kind of approach. And individual members have extremely little power or influence in the process.
So given what you just said, Magnus, about individual members having very little power, how can individual pension fund holders start to push back against some of these policy proposals regarding prescribed assets?
Well, first of all, and it applies to a lot of people, and I've seen it through many years in the industry, that people are very ignorant about these things. They don't read their pension fund rules. They don't understand them. They invariably in a kind of a language that nobody understands. So they tend to just accept it that someone is looking after my pension. And you have the option of getting onto the trustee board at your company level if you have one. And I've been one for many years when I was still in formal employment. And again, you have the pension fund consultants walking in, rambling off a lot of numbers, and off they go again. So it's a little bit of there's no real substance in these meetings, but you can upskill yourselves about the rules of your pension fund and start putting pressure on your trustees and start writing questions, because they actually are having to act for you up at fund level. So there's a lot of ignorance about pension funds, and on individual level you can get involved. At company level, and you do it via the trustees who will communicate with the actual professional fund managers. But the public media, or the media, is the best way to get involved. Is to really, hang it out for all to see. And this discussion needs to take place at a much larger level than it currently is.
Well, Magnus, thank you very much for raising awareness around this important topic. And I certainly think that the risk is still a present one. If you enjoyed this content, please do give this video a like, subscribe to the channel, and also check out the link in the description below to our 30-day free trial, where you can access all of our insights and analysis for free for 30 days. My name is David Ansara. Until tomorrow at 7 a.m., take care.